In this video, I'm going to show you everything you need to know about Fibonacci retracement and how to use it effectively when combined with price action. But before we dive in, make sure to like, subscribe, and turn on the notification bell. So, what exactly is Fibonacci retracement? It is a set of key levels based on Fibonacci numbers that allow you to identify the end of a pullback. We can find these key levels by using the Fibonacci retracement tool. The real question is, why should we use this tool to identify pullbacks? Let me give you a scenario. Suppose the market is currently trending and we want to enter a position. We know that the best time to enter a trending market is to wait for a pullback. This allows us to enter a buy position at the end of the pullback before the price continues in the direction of the primary trend. So, how do we know where the pullback will end? In my previous videos, I explained that pullbacks tend to end at previous key levels. For example, here we see the price moving up, consolidating, and creating a resistance level. Once the price breaks that resistance and pulls back, that previous resistance often turns into support. Generally, pullbacks end at these key levels, but what if the chart looks like this? The price is moving up and pulling back, but there's no clear previous key level. How do we know where this pullback will terminate? This is where the Fibonacci retracement tool becomes essential. By applying the tool to the chart, we get levels based on Fibonacci numbers. As you can see, the price hits one of these levels and bounces back up. The market respects these levels. If you are using TradingView, the tool is located on the left side of the screen. Click it and select Fibonacci retracement. For the settings, I recommend you copy my exact configuration so it's easier for you to follow along. Here is how you apply it. Step 1 is to find a clear trend. In this example, the market is clearly moving upward. Once the trend is identified, the next step is to apply the tool. To do this, you must first identify the swing low and the swing high of the move. The swing low is the lowest point before the price reversed upward. The swing high refers to the highest point reached before the price started pulling back. Remember, to identify a valid swing high, a small pullback must occur at the end of the move first. Once identified, connect the swing low to the swing high and drag the tool to the right to extend the levels. Notice that I connect the lines exactly at the tip of the candle wicks. Let's break down these levels. Starting from the top, you have the 0% level, which is your starting point. Below that are the retracement levels where the price is predicted to bounce. The most common levels for a pullback are 38.2%, 50%, and 61.8%. These three are often called the golden zone. However, there is no guarantee the price will reverse exactly there. It can go deeper to the 78.6% or even 100% level. The 100% level is the maximum limit for a move to still be considered a pullback. If the price breaks and closes below the 100% level, the move is no longer a pullback. It is classified as a trend reversal, downtrend. If that happens, you invalidate the setup and look for other opportunities. The most important point to remember is to treat these levels exactly like support and resistance. Treat them as zones, not just thin lines. You cannot just jump into a trade simply because the price touched a level. You must wait for confirmation through price action. Let's look at an example. Here, the price consolidates and slices through the 38.2% level. This shows the market is not respecting that level. Next, it breaks through the 50% level without any reaction. Finally, the price reaches the 61.8% level. Notice what happens. The price shows a small reaction, failing to break lower several times. But remember, a reaction doesn't mean an instant entry. You need further confirmation. We then see a bullish engulfing pattern, where the body of the second candle completely covers the previous one. This shows us that we don't just have a reaction, we have bullish momentum. To confirm it further, the next few candles are green and break above the 50% resistance level. Based on this price action, rejection at the 61.8%, a bullish engulfing, and momentum breaking back up. This is a high probability buy opportunity. For your exit strategy, place your stop loss below the nearest swing low and your take profit at the 0% level. As you can see, the price hit our target. You can also combine existing support and resistance with Fibonacci levels to create a confluence area. In this example, the price moves up and starts to pull back. We draw the Fibo from swing low to swing high. The price pulls back to the 38.2% level and consolidates. Again, we wait for momentum. The price then dips to the 50% level. If you look closely, this level aligns perfectly with a previous resistance level. We now have a confluence area. Prices have a much higher probability of bouncing when multiple factors align. When we see green candles breaking back above the 38.2% level, it confirms the upward momentum. This is a great buy opportunity. Now let's look at a bearish Fibonacci retracement example. Step 1. Find a downtrend. Sometimes traders get confused when they see a small move up within a larger move down. To keep it simple, use the 200 EMA to identify the long-term trend. If the price is below the 200 EMA, we are in a downtrend. Apply the tool by connecting the swing high to the swing low and drag it to the right. We wait for a reaction at the levels. As the price approaches 38.2%, several small candles fail to break above it. Then, a green candle breaks through but is immediately followed by a large bearish engulfing candle. This shows that while buyers tried to push the price up, sellers came back much stronger. This momentum shift at a Fibo level is a high probability sell signal. That's it for this video. Don't forget to like, subscribe, and hit the bell icon. Check out my previous videos to sharpen your trading knowledge. As always, trade smart, stay safe.